Today, held out to dry by the powerful. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Tony Wood, the head of the energy program at the Grattan Institute, in an opinion piece in the AFR, says that the latest 6-monthly gas inquiry report, which was released on Monday by the ACCC, does not go far enough. The findings of the latest gas inquiry report makes for depressing reading. The concerns identified are severely harming both gas and electricity consumers, and we've not seen the worst yet, he says. We covered this report in an earlier show and also discussed it last Tuesday in a live show with David Llewellyn-Smith. Put simply, the energy cartel are taking Australians to the cleaners and making excess profits in the process, largely war-induced thanks to the Russia-Ukraine situation. And by the way, 97% of the gas conglomerates are offshore owned, and so the excess profits are going offshore whilst crippling the local economy, businesses and households. Tony Wood makes the point that the stated objective of Australia's national gas market is to supply natural gas services for the long-term interests of consumers, but this is simply not the market described in the latest ACCC report. The report identifies serious concerns in 4 areas: a potential East Coast supply shortage in 2023, high and increasing domestic prices, ineffective competition in pipeline transmission and between gas producers, and breaches of compliance with competition legislation. In the face of these concerns, the ACCC's recommendations are a mixture of the good, the bad and the okay, he says. The federal government should implement the recommendations and go further. The ACCC report is focused on the East Coast market in 2023. LNG producers are expected to produce 167 petajoules more than are required to meet their long-term contracts. If the producers decide to export all the surplus, the East Coast gas market will be undersupplied by 56 petajoules, which is about 10% of demand. There are no domestic alternatives to address this potential shortfall. Therefore, the ACCC recommended that the Minister of Resources should initiate the first step in the Australian Domestic Gas Security Mechanism, the ADGSM, to determine if 2023 will be a shortfall year. Under the heads of agreement between the government and the producers, the latter would then be required to offer their uncontracted gas to the domestic market first. The Minister's already acted on those recommendations, and they should address the potential shortfall. But the ACCC has also endorsed the government's intention to strengthen both mechanisms, particularly in areas where gas exporters are not engaging in the spirit of the heads of agreement. And he said the need for these interventions is itself a sorry reflection on the gas industry and its relationship with Australian consumers. Gas prices are high and going higher, and the ACCC is very concerned that quoted prices up to twice already high levels will be reflected in long-term domestic contracts with industrial consumers and gas retailers. There have been a number of business closures already directly linked to the higher gas prices. Over the past year, the ACCC has referenced export parity prices, i.e. what the producer could expect to receive from exporting the gas, as the primary benchmark for domestic prices. But, unfortunately, international developments, notably Russia's war on Ukraine, have driven benchmark international prices from $3 to $10 per gigajoule to well above 40, and prices offered by LNG producers have largely followed that rise. The ACCC recommends nothing to address this problem. Among alternatives canvassed over the past couple of months, the most effective government action would be a windfall profit tax on gas producers. The ACCC identifies competition and compliance issues with the gas pipeline and producer markets that must be addressed, even though they would not deliver dramatic solutions to the problems we discussed above. Gas transmission pipelines have long been a source of tension between owners and gas shippers. The ACCC report indicates there will be sufficient transmission capacity to transport gas from Queensland to meet the possible 2023 shortfall. Now, that's more optimistic than the Australian energy market operator, primarily because the ACCC uses different projections for electricity demand, but the ACCC is concerned that pipeline pricing reflects a lack of competition, and ministers have already agreed to some incremental changes. A better solution would be to subject those monopoly businesses to economic price regulation. And beyond the issues around the heads of agreement, the ACCC has identified more evidence of an ineffective gas producer market. Its analysis indicates that the three LNG producers and their associates were, in 2021, able to, quote, exert their influence over close to 90% of the 2P East Coast reserves. In its view, the joint ventures that cover LNG exports are in effect engaging in joint marketing without ACCC authorization, and if so, they risk breaching the Competition and Consumer Act. The producers can be expected to strongly reject this allegation, at least on the basis that some joint venture partners have no interest in the Australian domestic market. But regardless of those arguments, he said the ACCC should implement its proposal that separate marketing be the default position. The federal government has most of the levers it needs, and it should act on the ACCC recommendations and, in some areas, go further if we want to avoid catastrophic consequences later. But of course the question is there the political will to do that? And more broadly, oil companies in the UK and beyond are enjoying booming earnings in recent months on the back of those rising energy prices, as households around the world have struggled with soaring bills. And to bring the point home, as The Guardian reports, bumper profits of nearly £50 billion shared by the world's five biggest oil companies prompted a chorus of calls for higher taxes on the sector, as UK households were told to brace for average annual energy bills of more than £3,600 this winter. The UK firm BP was accused of unfettered profiteering after it said on Tuesday that underlying profits had tripled to $8.5 billion between April and June, thanks to higher oil prices. It was its biggest quarterly profit in 14 years, and BP said it would hand out nearly $4 billion to shareholders as a result. The BP chief executive, Bernard Looney, whose total pay in 2021 reached £4.5 million, in February described BP as a cash machine even before Russia's invasion of Ukraine raised prices further. The company's profit between April and June was its second highest in BP's history and rounded off a period that will be remembered as one of the most profitable quarters in the history of the oil company. The UK government in May belatedly responded to political pressure amid soaring energy prices with a £5 billion windfall tax on oil companies' extraordinary profits. That was a 25% windfall tax based on profits made by the oil and gas companies and is expected to raise about £5 billion in the first year. Many North Sea oil producers were strongly opposed to a tax rate ahead of the announcement, warning they would deter investment in new supplies. And responding to BP's results this week, Will Webster, Energy Policy Manager at trade group Offshore Energies UK, said the increase in oil and gas company profits is because there's been a big increase in global prices, which UK industry cannot significantly influence. However, quarterly and annual results only give you a snapshot showing what has been happening in recent months, so they do not tell you much about the longer-term trends. It's worth remembering that prices have been volatile in recent years, with producers now experiencing periods of low returns and losses. But Rachel Reeves, Labour's shadow chancellor, said the eye-watering profits showed that the government was totally wrong to have given significant tax breaks to oil companies. And a host of MPs from Labour, the Liberal Democrats and the Green Party, as well as environmental campaigners, called for higher windfall tax on oil companies. The profits bonanza in the second quarter included a record $11.5 billion for BP's FTSE rival Shell, record profits of $17.6 billion and $11.6 billion respectively for US ExxonMobil and Chevron, plus $9.8 billion for France's Total. In the first 6 months of the year, the companies made combined adjusted profits of nearly $100 billion. As Russia's invasion grinds on, the research from Cornwall Insight predicted that the energy price cap on annual bills in Great Britain is on track to rise to £3,615 a year from January. That was an increase on its previous estimate of £3,363 made last month. The cap, which is set quarterly by the energy industry regulator Ofgem, was at £1,400 a year as recently as October last year. Cornwall predicts the cap will remain above £3,400 for the entirety of 2023, piling further pressure on household finances. People will be confronted by the latest profit announcement by BP, said Sharon Graham, the General Secretary of the Unite Union. The British economy does not work for workers and their families. Britain's real crisis isn't rising prices, it's an epidemic of unfettered profiteering. Further energy price increases in the coming months will also put further pressure on the UK's new Prime Minister, once Conservative Party members choose between Truss and former Chancellor Rishi Sunak by the 5th of September. And Reeves criticised the government for at the same time giving the oil companies 80% tax breaks for new investments, allowing them to reduce their tax bills by drilling for more oil. She said Labour would use extra cash from abolishing the tax breaks for a green energy sprint instead, as well as for more home insulation to cut energy use. People are worried, sick worried, about energy prices rising again in the autumn. But yet again, we see eye-watering profits for oil and gas producers, she said on Tuesday. Labour argued for months for a windfall tax on those companies to help bring bills down. But when the Tories finally U-turned, they decided to hand billions of pounds back to producers in tax breaks. That is totally wrong. The environmental campaign groups Greenpeace and Friends of the Earth also called for a much stricter energy profits levy. Doug Parr, the chief scientist for Greenpeace UK, said while households are being plunged into poverty with knock-on impacts for the whole economy, fossil fuel companies are laughing all the way to the bank. The government is failing the UK and the climate in its hour of need. Government must bring in a proper windfall tax on these monster profits and stop giving companies massive tax breaks on destructive new fossil fuel investments. Jacob Rees-Mogg, the government's Brexit Opportunities Minister, told LBC Radio, "I'm not in favour of windfall taxes. The energy industry is enormously cyclical. You need to have a profitable oil sector so it can invest in extracting energy." Looney acknowledged the difficulties faced by households on a call with analysts. Energy affordability is an acute problem for many, he said. We all have to recognise that it's a very, very difficult place for people, not just in the UK, but also around the world, he said. We understand that, we get it. But he also said BP's oil and gas operations were doing what it's supposed to do, capture the upside from higher prices. And BP also said it had enjoyed massive growth in profit margins from its refineries, which make products such as petrol, diesel and jet fuel, all of which have contributed to rapid inflation in major economies. Environmental groups said the windfall tax receipt should be invested in energy-saving measures, such as insulation for homes, in a move that would help to address the climate crisis, as well as reducing dependence on despotic oil and gas-producing regimes such as Russia. A Treasury spokesperson declined to comment on individual taxpayers, but said the £5 billion energy profits levy would help pay for our £37 billion support package, which includes direct payments worth at least £1,200 each to the 8 million most vulnerable families, plus a record fuel duty cut and a national insurance cut worth up to £330 a year for the typical employee. But the head of the United Nations has also accused oil and gas companies of grotesque greed and urged every government to impose a windfall tax on their immoral record profits. António Guterres, UN Secretary-General, said money made on the back of the poorest must be returned to the most vulnerable households, just days after BP and Shell reported those massive profits in the wake of the Ukraine crisis. The UK, Italy and Spain have all pushed through windfall taxes on oil and gas companies, despite warnings they will damage investment crucial for energy security. Mr. Guterres called on all governments to follow suit after oil and gas prices were sent roaring by Russia's invasion of Ukraine, and he claimed that energy firms and their financial backers, which typically include retail investors and pension funds, are punishing the poorest and destroying our only common home. Writing on Twitter, he said, "It is immoral for oil and gas companies to be making record profits from the current energy crisis on the backs of the poorest at a massive cost to the climate. I urge all governments to tax these excess profits and use the funds to support the most vulnerable people." The Secretary-General, a socialist former Prime Minister of Portugal, has repeatedly used his office to highlight the global gap between rich and poor. Last year he hit out at billionaires who joyride into space while millions go hungry. And in 2020, he claimed that inequality defines our time. Too right on all of those. But of course, it comes back to political will. Will our politicians want to take sides against the big oil and big finance and big gas? That is the fundamental question now. Because it's clear to me that at the moment, the settings here in Australia and around the world are very much in favour of the big guys, whilst ordinary households and businesses continue to get crushed. And unless those fundamental parameters are changed, this is going to continue. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.